business news, we're news for business people.
Hello and welcome to Bloomberg Quint with the top headlines. Benchmark indices trade weak ahead of the RBI policy. In the Nifty trades below the mark of 10,100. Banks fall ahead of the RBI policy decision. And metal stocks are the top losers on the Nifty after a fall in the LME base metals index, which saw the worst decline in over 2 months. The RBI Monetary Policy Committee may choose to stay put on key rates, shows a Bloomberg poll of 46 economists. And Future Supply Chain is looking to raise 650 crores from the primary market. The IPO opens for subscription today. Those are your top headlines. I'm Agam Vakil. Up next is Hot Money with Darshan Mehta.
Thank you, Agam. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show, Ashwin Agarwal of Newberry PMS, Kalra of Target Investing, and Amit Mantri of 2.2 Capital. All of them join us on the show. Thank you all for joining us on the show. Today on Hot Money, we discuss stocks like Dish TV, Sandur Manganese, Manpasand Beverages, Greenply, and ENIL. Straight to the first stock, and that is Dish TV. Despite coming out with a weak set of numbers, the counter seems to be trading on the higher side. The market seems to be a lot of brokerage notes that came out actually factored in the synergies that will come in post the merger with Videocon D2H. So that's the traction that's happening on Dish TV. Most of the analysts are bullish on it. So out of 30 analysts that cover the counter, 25 are bullish, have a buy recommendation, 4 have a hold, and only 1 has a sell recommendation. So the street seems to be bullish on Dish TV at this point of time. We'll ask our experts. Amit, I'll start with you. Dish TV, good, bad. What do you make of the number, and what's the outlook ahead for Dish TV?
Yeah, so I'm broadly bearish on Dish TV, and largely because one, it's among the weaker players in the DTH space. Yes. I would much rather prefer Airtel or Tata Sky. Airtel you cannot play because it's part of the larger telecom business, and Tata Sky is not yet listed. Dish TV has higher number of subscribers, still a much weaker mix of subscribers. It's largely dependent on rural subscribers, and therefore its ARPU and profitability is significantly lower compared to its peers. And from a operating point itself, you know, if you look at its history, hasn't quite done well on the profit side. And when I look at the longer term picture, things look even more difficult, because now over the longer term you will have challenges of cord cutting starting to impact even in the Indian markets as well. It won't happen over the next 1 year or 2 years, but over the next 5-10 years we are definitely going to see that trend, just as it is playing out in the US market. And when that happens, as you have seen in the telecom market also, when disruption happens, the weaker players get impacted the most. The stronger players are able to benefit by acquiring the market that has been left over by the weaker players, but the weaker players pretty much get massively killed in this entire disruption process. So therefore Dish TV I'm negative purely because it's, as a business, it's among the weaker of players of all, and there is a long-term disruptive threat that it's facing.
Okay, so and what about the merger synergies? Do you think that could potentially aid them?
So I don't really count a lot on merger synergy, because every time a transaction is announced, a large thesis is based on the synergies that will come out of it. Even in this case, there is a large assessment that what will be the merger synergies. Most people expect that it to be fairly back-ended, 2-3 years down the line, those synergies will come in. We really have to see if those are actually real or just it's consulting speak to justify the merger. And
just a sense, because I'll take it from what you were saying, that you know, because you can't play Airtel or a Tata Sky because this thing. What about these cable guys like a Den Network or this thing? Because they pretty much will be part of the same. It's not a direct to home, but are you negative on them also?
Yes, pretty much. So if I had to, in this space, if I had to play something, I would have liked to play a Airtel and a Tata Sky. Tata Sky might come out with an IPO sometime in the near future, and that might be a much better opportunity to play this entire digitization wave on the DTH side.
Okay, so that's your views. Samir, do you have a view on Dish TV?
I have a neutral to bearish. Okay. So everyone is optimizing on the synergies they get post-merger. So even the company said they'll have 180 crore in FY18 and 510 crore synergy benefits in FY19. See, the only thing is, if you see the combined entity, today they do around a 4,800 crores kind of operational expenses. Majority of it, around a 50 to 60% comes out from programming costs. So the merger doesn't affect the programming costs because it has now no relation with two entities giving higher number of subscribers. It's more of per subscriber how much cost of programming cost is there. So over there, that reduction of synergies I don't see. So I am still very bearish on it, and I would like to see where that cost synergies do play out.
But they are indicating that they will get rid of a lot of non-core assets. They did it with their sports channels, but that won't help them.
Even if you see that, if you see Videocon numbers, because it's a GDR, so they release the numbers. Videocon from March 2017 to September 2017 had around a 16 crore kind of a debt, 23, 25. Now they have a 16 crore long-term debt plus a 46 crore short-term. That short-term is for the working capital finance. So as they get merged, the balance sheet of Videocon is also going down. So I really don't know whether I want to have my investors invest in it at this point, rather than getting the whole system playing out.
Okay, so two negative views that are coming in on Dish TV. Ashwin, do you share the similar view?
No, I have a contrarian view, so I'm bullish on Dish TV. My reason is I like industries that are consolidating. So with Dish TV, if you see, their ARPU is significantly higher pre-demon, and since they are more focused in the rural areas, their ARPUs have depreciated significantly. So what happens with the merger is you have to look at Dish TV plus Videocon as a distribution channel. So basically they pay the channels money to carry the channel on their network. So the more the industry gets consolidated, I think the more pricing power they'll have, the more operational benefits they would have. The OTT thing is a real threat, but I honestly think that TV will survive. So basically there's been online video since 2000, I think, but still people prefer watching stuff on TV. So I think it might play out over the next 10-15 years, but I don't want to take that call right now. It would be too subjective. So I think it's a good play on consolidation for the next 1 or 2 years. I think it would be a good investment.
And you're happy with the financials, the losses that it's reporting?
So I mean, I'm looking at the future. So they are reporting losses of like 100 crores, but the thing is the delta could change really quickly if they could increase their ARPUs. So, they increase their ARPUs by 10%.
How? How do you think that they will do?
Pricing power. There's fewer distributors now. So see, if they will own 40% of the market post-merger. So I mean, they do. Like the industry automatically increases prices.
Okay.
So I'm not saying only Dish TV will increase, I'm saying all the players might increase it.
Okay. But if you see the combined EPS even today, as in
but
Dish
I'm not
plus
investing
video,
for today.
I'm just saying,
years out.
It's like point.
So even if you assumed all the synergy benefits that the management is talking about comes into play actually.
Synergies on the cost side, but I'm also saying on the revenue side, in general, the ARPUs will increase, so is my opinion.
At least, the way I would look at it is the cord-cutting threat is real, absolutely real.
Can I tell you something? In the US, the cable cost per month is $40.
Yeah.
In India, it's 150 rupees. So maybe the cord cutting might happen in the US because it's a genuine expense, like $40 versus $3.
But for example, Netflix now already provides 4 screens at 800 rupees. So that's 200 rupees per screen.
But TV Netflix doesn't provide news, live TV. It doesn't provide sports. It doesn't provide a lot of stuff that's there.
The same arguments hold for the US market as well.
Yeah, but I'm saying US cable companies are not doing badly.
But if the cord-cutting phenomenon is almost a 10% decline in viewership of
because the annual cost of cable over there is really high. You compare that to India, it's quite low. I mean, it's 10 times.
No, your logic is fine, but if you see Videocon has a 200 rupees kind of a ARPU.
Yeah.
Now, why is it merging with Dish? My whole point is that
because it'll benefit both of them.
So that's what I'm saying.
So if there are 6 players in a market, everyone's undercutting each other, but now there are only 2 players.
Okay.
So if us three were the only PMS managers in India, would we charge higher versus if there were 1,000 PMS managers?
No, but why will I go with a higher revenue?
Okay, so I think we have more stocks to discuss. But that's the view that's coming in on Dish TV. Two negative views that are coming in on Dish. Ashwin, on the other hand, is bullish on the counter. The next stock that we'll talk about is Sandur Manganese, extremely strong move that came in on the counter yesterday, post a stellar Q2. Even today, the counter is up almost 4%, and it has been a marked outperformer as far as the entire metal space is concerned. It's up almost 70% in the last 6 months. Samit, any view on Sandur Manganese?
So I'm neutral to bullish, given two reasons. See, iron ore mining is capped by IBM, that's the Bureau of Mines. So that caps the mining which is allowed for a firm. So in August 2016, they were allowed from a 0.8 to 1.6 million tons of iron ore mining. That they achieved in March 2017 quarter. So that's why if you see the numbers from March onwards, Q on Q, it has a big jump. So over there, what happened now? They have a total capacity of 3 million tons. They've been allowed 1.6, and in 2016 end onwards, they were talking with JSW Steel for supplying all the iron ore they have, because the closest proximity of a plant is JSW Steel. So they have a ready customer. The only thing which I want to see is the a further expansion of that capacity. So I'm quite bullish on it, but the only thing is
it's a wait and watch for you.
I'll wait for the next 2-3 quarters where the approval comes. Generally, it happens in July or August.
Okay, so Ashwin and Amit don't track the counter, but Amit, just a quick word. Any view on the mining and the metal space as such? Because we've seen a big sell-off that's happened. Overall, do you have a view on metals as such?
No, the way we see is the metal stocks pretty much rally with the commodity prices. We have seen some correction in commodity prices over the last few weeks because of China concerns, because of US concerns. So that's what happens, and we don't really track the space largely because we think we have no ability to predict what happens to a large number of these commodities. So we tend to avoid pretty much all the commodity sectors because it's difficult to make a fundamental call on these businesses.
Okay, so that's the view that's coming in on Sandur Manganese. Samir here is neutral to bullish. It's a wait and watch for him, but overall he's saying it's neutral to bullish stance for him. The next stock that we'll talk about is Manpasand Beverages. The stock is down 25% from the recent highs. Today it's absolutely flat in trade. What seems to be the concern? What's plaguing it? Valuations at 40 times this year's earnings, 30 times next year's earnings, and ROC in single digit, and return ratios in single digit is something that we're seeing. Ashwin, what do you make of this counter?
So I'm bearish on it, mostly due to valuations, but if you analyze the company, it's in the beverage industry, but their raw materials cost is 60% of their sales, and below the raw material is 10 to 15%. So it's more like a manufacturing company. They also have huge capex. But I mean, in all fairness to the management, they have been raising money at really high stock prices, and now they have this war chest. So the future of the company would depend on how they deploy this money that they've raised. If they deploy it in brand building, it could do well, but if they deploy it in doing too much capex, that increases the business risk. Then you have to assume that you will do a significant number of volumes and stuff like that. So I think if they have a lot of money now, if they invest it towards brand building, it's good. But if they invest it in capex, it's bad. So right now I'm bearish, considering all the risks.
Samit, what's your view? What seems to be the problem?
So I'm bullish on the stock. See, what happens generally, people compare it to a Maaza or a Fruity. Now I'll tell you the plus point of the firm. So they are only present in majority, 60% of the revenue comes from 5 to 10 rupee kind of SKU. Over there, the only competitor they have is Fruity. So Slice and Maaza doesn't play over there. So already out of 3 competitors, 2 competitors are out. Second is they have around a 4 lakh retail outlets. The capacity was around 7 to 8 lakhs 2 years back per day. Now it's around 15 lakhs. So what money they have raised in 500 crores QIP, they are doing a 600 crores capex in next 12 months. So that takes...
If the small SKU thing becomes really profitable, what will stop Maaza to not go in and destroy that market?
See, what has stopped Maaza to go from there to today
I remember
also.
at one point
See,
Maaza used to sell a 5 rupee bottle, right? Because they just wanted to take out all the competition.
Yeah, because they were not successful. See, that's the only point.
They don't want to be successful, they just want to destroy the competition.
See, the only point is, the only minus side of being in that SKU is your pricing capabilities get out. So that's why if you see the margins are lower over there.
Oh.
That's why you see that, so even a Dabur does a 12% EBIT. They are around 9%. So it's not a bigger difference. Their pricing point, if you see a 1.2 litre bottle, is around 32 rupees. The same for others is around 55, 65. Now the only point is, if Fruity is the other competitor and Parle is the owner of that, they had joined hands in September 2017. So now the 1% gets access to 4.5 million outlets, which Parle has.
But
they're
already
running.
Sacrifice margins.
See, the only point is it's about distribution again. Now, if in consumer, the whole point is when the demand comes in, your supply is not there. So your capex has to be there. It takes 12 to 18 months for them to set up the double.
Coke and Pepsi over the years, they realize that it's not profitable to own the bottling companies. So
their main is the Tetra Pak. They don't
have bottles.
But they have
whatever
bottles,
they're earning, the capex,
they don't
the gross
push it.
blocks around 600,
See, the whole
700
point
crores,
is it's a very small company. If you take it, it's around 500, 600 crores kind of a mango sip and 180 Fruta. Now the only point is, if you're only in 4 lakh retail outlets and you have an opportunity of going to 45 lakh, right? You already have a tie-up with your own competitor, which is Parle.
I think the success should depend on brand building rather than capex.
See, the only point is, if you don't have a capacity to provide further, if you talk to their distributors.
But are they running on 100%
yeah,
utilization?
they do.
Or they're running
they
on
do. So that's where the whole, because see, for them, March and June quarter is the highest quarter, and September and December is idle ones. So
season.
So that's the summer and the winter playing off.
Okay, so you're giving more of a bullish view. Amit does not track the counter, but Amit, which your favorite mango drink? Maaza, Fruity or mango sip?
I love Fruity. Yeah, that's my favorite.
Okay, so that's the view that's coming in on 1% beverages. A bullish view that's coming in from Samir and a slightly bearish view that's coming in from Ashwin. Before we move on, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, the next stock that we'll talk about is Greenply. The counter did manage to move up significantly. The management held an analyst meet in which they gave very strong commentary in terms of the volume growth that they are talking about. They're saying 12 to 15% volume growth. They're talking about their margins. The stock is obviously trading at a fresh lifetime high, and obviously the GST benefit also passes on to some of these plywood players. Is there room for the company to grow even further? We'll ask our guest Samir. I'll start with you. Any view on Greenply?
So I'm neutral to it. I'm waiting for the capex story to play out, because it'll only play out in September to October 2018. So what is happening is they are leader in the MDF and the plywoods. So they have a 26% market share in the plywoods and 30% market share in the MDF. Now MDF growth is higher in terms of volume as compared to the plywood, because it's more like a premiumization being played out. Now what they are addressing is that they'll have a MDF capacity by September to October, which makes them around a 80% capacity increase, and on the plywood they want to do a 40% plywood capacity increase. Now the whole story with them is, if you see the unorganized plywood and the Greenply or Century Ply, before GST came in and before demonetization came in, the premium was around 20 to 25% between unorganized and as in a local plywood and them. That has post GST come down to 10 to 12%. So now the whole point is they are able to push off more product, because eventually the retailer who's selling the product looks at the demand, and if that premium discount is there to the local, as in that has reduced to 10%, he's more motivated to sell a branded, because he gets a higher margin at that point of it. So that's where I want to see the capacity expansion play out, because during that the numbers will get affected and there will be a certain kind of a loss of market share. because Century is ready with certain kind of capacity being played out.
Okay. What about you, Amit? Green play?
So I'm neutral to slightly positive. The near-term concerns are with regard to end market demand, what happens to real estate demand, where plywood is the largest consumed. But when I look at a longer-term perspective, a lot of what Amit says makes sense. There is clear shift because of GST, which is likely to happen over the next 4-5 years. Unorganized segment will have to raise prices, or it'll allow the likes of Greenply and Century to reduce their prices, which makes them more competitive. The second thing that on the premiumization story is just similar to what has happened in the tile space, where the likes of Kajaria, Somani have been able to move up the margin curve by purely going after the premium segments, which is GVT, PVT tiles, and let the unorganized focus on the basic, without any value addition tiles. So even in this market, we'll probably see happening the same thing, wherein the unorganized will focus on the cheaper plywood, and these guys will probably focus on the higher end plywood and other products, be it laminates, be it MDF. And in these categories, premium brand will matter, just as it has mattered in the tiles and other home improvement spaces. So in that sense, positive on the longer term. The near term is there are a lot of issues in the near term. There's end market demand issues, the capacity addition. There's tons of capacity being added in plywood, in MDF, which will result in some sort of margin compression because it will take some time to ramp up. So I would have liked the stock to be a little cheaper for me to be compensated for this near and medium term risk that I'm taking. But from a longer term, it could still be quite attractive.
Okay. Ashwin, your view on
So I'm bearish, but that's just the valuation call. I think plywood's a commodity item, and not a lot of players will have pricing power in the long run. So it's a good stock. If I could get it like at 15 times, I would buy it.
Okay, so that's the view that's coming in on Greenply. Slightly negative view coming in from Ashwin, but the other two guests are slightly neutral to bullish, but they will have to see the story that's come out. And final stock of the day, ENIL. The stock's down almost 10% from the recent high. What's the way ahead? Ashwin, very fast, you're running out of time, but what's your view on ENIL?
I like ENIL. I think the radio business, they just had the auctions and stuff, so there's a lot of operating leverage that's going to kick in. Now it depends on how successful they are. They've gone for double stations in a couple of cities and more stations in a bunch of places. But it's a good management, and they're also getting into concerts and stuff like that. It's a good bet for a small percentage in the portfolio.
Okay, what about you? ENIL, any view?
So I'm neutral. I'm just looking towards, because real estate was like a 60 to 70% of advertising pricing for them. So real estate is out because of the RERA and the demonetization. So I'm waiting for that to come in. The management says it should come back by Q4, but I'm still a little pessimistic about it.
Okay, and what about you? Finally, if your call on ENIL?
Fairly bearish. Again, the same near-term risks are there, but even the longer term is quite uncertain. Believe that radio as a business might be extinct in 5-10 years, because just the way digitization is moving, people are now consuming music on smartphones in cabs rather than listening to the radio. So if you were listening to a Nilesh Mishra show on a radio, you're now watching or hearing the same on a Savan app on your mobile, and now you can do it whenever you want rather than when you're stuck in that.
It's like the Bloomberg Quint model.
But yes. The iPod came out in 2000. Those Walkmans.
But the data story is only now coming in play, wherein everyone has access to music.
I mean, earlier you could just have it on your phone, the music.
Okay. I think we're running out of time. Before we wrap up on the show, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, before we move, Raghunandhan, NL Raghunandhan, the senior auto analyst at Emkay, he joins us on the show. Thanks so much for joining us on the show, and he joins us on the sideline of the Emkay conference. First, a word on what you're seeing as far as the entire auto demand is concerned. What did you make of the numbers that came out as far as the auto numbers that came out for the month of November?
So auto numbers for the month of November have been extremely strong, numbers, especially in medium and heavy commercial vehicles, have been above estimates, and we believe there are three reasons which are helping them. One is the restrictions on overloading. Second is the strong demand or sales of construction tippers, and third is the replacement demand, which is slowly coming back. So apart from that, even on the passenger vehicle side and on two-wheelers, we see continued strong demand. And another segment which is closely linked to the rural demand is tractors, also continues to do well. So across segments, the sales have been strong, but I think the highlight or among all the segments is the standout performance of commercial vehicles. We believe there is a true turnaround happening in that particular segment.
Okay, for Maruti is one of the counters which has done extremely well over the recent past. What's your recommendation and your current view on the stock?
So we have a positive view on Maruti Suzuki. The company has been benefiting from a strong product portfolio. Many of its new products have done extremely well. There are huge waiting periods on 3-4 of its products. Apart from that, even the product launch pipeline stands strong for Maruti, and Maruti is also one of the key beneficiary in terms of the uptick in rural demand and also the uptick in the urban demand. On the rural demand side, Maruti derives more than 30% of its volumes from that segment, and rural demand last few months have been very, very strong.
What about Bajaj Auto? You have a whole recommendation, but the management, coming to the stock, the management talks about improving domestic and export markets volumes. Do you see a chance of an upgrade or better than expected earnings to the consensus coming in for Bajaj Auto?
So Bajaj, the positive thing for Bajaj is two of its segments has been doing extremely well. Number one is the exports. Because of a low base and pickup in some of the key geographies, exports are now growing at double digits, and we expect that trend is likely to continue. Secondly, the domestic three-wheelers is also seeing a very strong growth, helped by opening of permits in some of the markets and also removal of permit in states like Maharashtra. But one segment where there is an area of concern is the domestic motorcycles. So this segment, some of its products such as Avenger and V, the volumes for these products are lower than what they were at the last year, and also absence in the scooters segment has hurt their overall market share in the two-wheelers. So we believe that it's a mixed bag, and overall, though there is growth in the company, within this space over Bajaj Auto, we would still prefer Hero MotoCorp.
What about commercial vehicles? Because that seems to be, a track that is doing well. What is the on-ground check suggesting? Do you think that discounting on heavy commercial vehicle remains high on the ground?
So in our dealer conference, we now have 3 dealers representing the CV space: Ashok Leyland, Tata Motors and Bharat Benz dealers from the north and the western regions. So one, on the demand side, the view is extremely strong. The reasons which I highlighted earlier, the construction tipper sales remain strong, replacement demand is coming back, and also the restrictions on overloading is helping the demand. But on the negative side, the discounts have been higher. So compared to last year or compared to few months ago, the discounts have been trending higher. So it's a mixed bag because volumes are strong. At the same time, the competition intensity is also higher and discounts are also higher.
Okay, let's stick with the CV segment. What kind of volume growth is expected for Ashok Leyland and Tata Motors going ahead?
So Ashok Leyland, we believe for the MHCV segment, they can do more than 5% growth in the current year. Please remember that when they started off the year in the first quarter, the volumes were down by more than 10%, and slowly that recovery has come. On the Tata Motors also, we expect them to end the year with a slight flattish to a marginal growth in the segment. and we think that next year the growth would be better and closer to high single digits to a double-digit growth for both these companies. And I'm referring to MHCV space.
Okay, we'll leave it at that. Thanks, Raghunandhan, for joining us and giving us a perspective of your view on the auto space. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.